MIRA Business FM, where business comes to talk.
MIRA Business FM, this is the morning drive, Friday the 13th, I've just realised, February 2026. Today, insights on the Dubai housing sector. Ronan Arthur is the Director and Head of Residential Valuation at Cavendish Maxwell. The firm's Dubai residential market performance full year 2025 report shows that the Emirates housing market ended the year over 200,000 sales transactions, 541.5 billion dirhams. That's the figure, driven by strong investor interest, robust off-plan activity, even as price growth begins to moderate and the supply pipeline expands significantly. Lots to talk about, Ronan. Good to have you back as well.
Thank you. Good morning, Tim.
Nice to see you. Look, let's pick through some of the findings of your report for last year, some of the standout bits, I think. What for you are the most surprising takeaways in terms of, performance data?
I think in terms of surprising, Cavendish Maxwell publish a report each quarter, so we kind of knew that we were on track to be in and around 200,000 transactions, and that the dynamic price index, which we gauge values and how they're performing, that was probably going to be down from the 16% in 2024, so it finished around 12. Rents, the rise in rents was slowing, and on the back of that, the yields decreased. So I suppose there was nothing that surprised me greatly, but what does surprise me is people's reaction to the stats and the data, because people expect almost records to be broken year on year. So they see this as a norm, which obviously we know, having been here a number of years, certainly isn't. We're almost 5.5 years into this cycle, and each year has been a record year, records across the board broken.
Yeah.
I remember we were also impressed in 2022 when it almost reached 100,000. You multiply that by 2 now, that's where we're at now. Cavendish Maxwell have a graduation program. We take grads straight from uni every year or every 2 years, and I think in this cycle we're probably into our third batch of grads. So from uni to us, so we will guide them through the whole APC process, ultimately to become a chartered surveyor with the RICS. So since their career started, they've known nothing but this market, this type of market, with record after record.
Yeah.
So I think that's interesting, because I think a lot of people have come to Dubai since after the pandemic, and we've obviously seen a huge rise. Yeah. And I think maybe the general public or people that have arrived since then think this is the norm for Dubai. But obviously the last batch of grads that we had started in October. None of them had been in primary school when Lehman Brothers failed. So back in 2009, when what was occurring here, the correction that time, they might be aware of it, but they've not worked in it, or they've not lived through it. So I do think it's a good sample size. Our grad and people who have arrived in Dubai over the last 4 to 5 years see this as the norm. So it surprises me that people are not surprised that year on year we're having record after record.
Yeah. This is the thing, isn't it? When something becomes the norm like this, it is the norm. There is no other way. That sense of history, Lehman Brothers that's just a footnote.
Absolutely.
Isn't it? And to go through those things, that's going to be a shock to the system, isn't it, I suppose? But, in relative terms, when things are going great, they go great, and then they correct slightly, and that's just the way things are. It's going to come.
Yes.
Anecdotally, we're kind of reading at the moment that things are going to correct. Most people agree with that. Is that how you look at 2026?
I do. I think what we saw towards the end of last year was that price index have 2 consecutive months where the price fell. Now, I think there's a number of factors involved in that. Launches last year, there was probably close to 680 new projects launched.
Yeah.
That's a lot of developers in the market. There's varying sizes of developers. The main players who will launch townhouse and villa communities and towers within master developments, they can tend to charge a premium and a higher value or a higher cost for their products. And then you have a lot of newer developers, unknown developers that are entering the market, where they might be building one-off towers, where basically their values, they can't charge the premium that the bigger developers charge. And there's a lot more of those entering the market now because obviously they've seen how lucrative it is. These developers are coming from all over the world because of the situation with the Dubai residential market. So those lower values are coming to the market. And I think as more and more come to them, you will see slight adjustments when it comes to, I guess, the overall average value in the communities, in certain communities. And going forward, I think you'll see more of that, but also you'll see obviously more and more handovers come, which will obviously increase the ready supply, which will have an effect on values going forward.
Can I put a few thoughts to you? I was looking at your report last night, and just a few things that struck me. And feel free to point out any flawed logic as well, Ronan. Your colleague at Cavendish Maxwell, Zaki Sajjad, who's been in this studio, has been on here a couple of times. He's quoted in the papers at the report launched this week. 10 to 20% of people are reselling their off-plan units. So the majority of people are holding on to off-plan assets. Is that because people aren't getting the returns that they hope for? Because, getting 25% deposit together isn't easy for most of us, obviously. So if you follow the logic, if we're seeing a slower pace of off-plan resales, does that also point to a correction of sorts?
I think there's a number of factors that affect that side of the market or that section of the market. I think it's more difficult to sell an off-plan unit on the secondary market, because if someone is looking in that particular development and there's stock available directly from the developer, multiple units, then someone would prefer to have a choice rather than a specific unit. I think agents, it's more attractive for agents to sell directly from the developer because their commission is higher if they sell directly from the developer, whereas if you're selling a unit on the secondary market and it's off-plan, you'll have to come to an agreement with your agent, and it's likely to be in and around 2%. So it's more. So I think it's harder for people to sell these units. So that's why I think less people are selling. That's the sort of range between 10 and 20%. People are holding on to them also because they've seen the increase in the that the premium attached to them is increasing as time goes by.
Okay. I mean, to be fair, Zaki did say, when we look at it from a year-on-year perspective, we're pretty healthy. I don't mean to be doom and gloom this morning.
Absolutely.
A correction of sorts is probably a good thing, isn't it? So with off-plan accounting for about what? It's 73% of activity, I think the figure was.
Correct,
completions coming in below initial projections. How do you see supply dynamics influencing the balance between the buyers and the developers?
I think as more and more stock is handed over, so I suppose the percentage of completion, what was forecast and what was actually handed over was less than 50%. And next year, it's projected that 100,000 units will be handed over, and it's likely to be under 50% again because there probably isn't the developers or the contractors in the market to be able to hand over anything over 50,000 units. But obviously 50,000 units has a big effect on the market. So I think as buyers have more options, then yes, oversupply in some areas will lead to, again, prices being affected.
There's no reticence when it comes to appetite, investor appetite, is there?
It doesn't seem to be.
So talk to me about the international demand and local demand, because outside looking in, to me, if I can use really simple terms, people are piling in.
They are, very much so.
Aren't they?
I mean, you have to look at, I suppose, people from outside, foreign investors, are looking at how the market has performed over the last 5 years and the premiums that have been achieved. I think the tax setup here suits foreign investors in that there's no tax on their income or on their rent. There's no capital gains on any gain that they realise, and obviously the inheritance tax comes into it as well. So for foreign investors, and the yields are high. The yields are still for apartments between 7 and 8%, and almost 5% for townhouses and villas, which is considerably higher than a lot of the cities globally.
So we've got this situation here where we've got launch after launch after launch, and I can't keep up. I say this to every real estate person in this room has to go through my how do you keep up question. It's very difficult.
It's very difficult.
So there's a real reliance on the kind of future project launches, and that consequently means rising supply,
Correct,
of
yes.
course, as well. So does that combination pose risks to price stability, do you think, going into this year?
I think absolutely. As I spoke about already, I think the more supply of ready stock that comes into the market will affect values going forward. And I think that's what we probably saw last year, where an amount of stock came and it had an effect towards the end of the year on values. And I think you'll see probably some communities will maintain and maybe will increase values, and then you'll have some where values will decrease. If you look at JVC and Business Bay, they've over the last number of years have always topped the areas that have the most numbers of secondary market and off-plan transactions. These areas have new stock and they have older stock that may be inferior to when it's compared to the newer stock. So due to that, prices for the older stock has to maybe go down in order to compete with the newer stock. And obviously we're talking, these two areas have been the highest selling areas over the last number of years. So it affects the average across the whole market.
JVC is constantly, it's always there, isn't it? The number of people that I speak to moving into a studio there, or it's always there or thereabouts. How should an end user or an investor adapt to their strategy, I suppose? Given that most of the conversation this morning seems to be that we're moving towards maybe a more what's the right phrase? Maybe a more balanced.
I think a more balanced is fair. Yeah. Well, I think investors or end users, have to look at an investment or a purchase of a property long term. So we've seen obviously different cycles here in Dubai and how prices have gone up and down. But I think long term, real estate is still a sound investment here in Dubai. So I would say that the more stock again that comes to the market, the more options they will have. And obviously, currently it's a seller's market when it comes to the villas and townhouses. But maybe towards the end of this year and at the start of next year, you'll see more and more townhouses and villa communities be handed over. And again, purchasers will have more options. I think if you look at the type of assets that were sold last year, over 50% of the 220,000 that were sold were studios and one beds. So studios and one beds generally are bought by investors. Maybe some are bought by purchasers, but they're generally bought by investors. So when people talk of an oversupply coming, I think we have to actually drill down into the data and look at what type of assets are being sold. And studios and one beds are mainly investment properties. Yeah. And what you'll have here in Dubai are people that will rent long term, people that will rent short term because of it being a tourist destination. Sure. And also people invest in property in Dubai and just leave it empty because they want a liquid asset so that when they want to sell it, they can sell it quickly without a tenant. Yeah. So I think all these factors come into it.
It's something for everybody, isn't it? Dubai market?
I think it is. I mean, if you look at the super prime market, in the report it says that there were 306 units sold over 50 million dirhams this year. So, I mean, that's across a number of different communities, but Palm Jumeirah Bay Island, and Lumiere on the beach, and then Emirates Hills, Dubai Hills on the golf course, Jumeirah, mainly around Jumeirah 2 along the canal. So I was so that standalone is like, okay, that seems like that's a lot of units. So then I said, well, look, I'm going to just look and see at another city maybe and compare it. How does it compare then? And we have a benchmark. So I looked at New York. I know it's a city you like to visit and I like to visit also.
Absolutely.
So last year in New York, the number of units sold at $10 million and above was 284. Okay, so there was 306 units sold at $13.7 million here. That's the 50 million dirham mark. So then I said, okay, let's look at how many units were sold for $10 million here, and it ended up being over 520. So 520 compared to 284. So that's 87% more units sold, 10 million or more in Dubai than New York last year. And New York is more of a global wealth hub than Dubai is. Dubai has increased over the last 10 years, but I think in the last 20 years, the most that have sold in New York was around 400 in 2021. So Dubai is outperforming New York on a huge basis.
I was going to say substantially.
Substantially.
New York.
The most expensive unit sold in New York last year was 300 million dirhams. In the top 10 highest sales last year, that would have ranked 6th in Dubai. So 220 Central Park, a 5-bedroom villa, 2 Central Park Tower, a 5-bedroom apartment, sold for 300 million. That would have come in 6th. The highest one in Dubai last year was obviously that Bugatti residence, which sold in December for 550 million dirhams.
Yeah.
It was 47,000 square feet. That's almost size of 8 signature villas on the Palm.
I'm trying to get my head around the size of that, not just the figures.
Yeah.
See, that's such an interesting comparison because, historically, if you said, Fifth Avenue address, the kudos that goes with that.
Absolutely, yeah.
But here we are in Dubai, living here for a number of years, and all of a sudden, it seems, we're not just on the same level, we are rising above that kind of Fifth Avenue address. It's a remarkable state of affairs.
Absolutely, and I think obviously that's at the higher end, but when I spoke to someone earlier this week that was in Miami on holidays, and they told them they were, working in Dubai and had been living in Dubai 20 years, and they all know about Dubai now.
Yeah.
So and that's why we have so much foreign investment coming to purchase real estate here.
It's interesting now. I was in south of France a couple of years ago, in Saint-Tropez. Look at me. Hey, Saint-Tropez. but for some reason, but I met a guy there. I was in a restaurant. I met a guy, and he moved between Miami and the European winter, if you like, and Saint-Tropez in the summer. And they just, where are you from? And I just said, I live in Dubai. I'm just here for a couple of weeks. And the recognition was immediate. You could see, and the interest was sparked. So, we're certainly, that's the level we're at now. I think that was just me showing off that I went to Saint-Tropez for a couple of days, but there you are.
You said a few weeks.
That part was a couple of days, let me tell you. But we are there, that's the thing. Let me ask you a little bit about the residential market, the luxury homes, but more kind of family housing, if you like. Where's the outperformance? What's doing particularly well at the moment?
I think, speaking to agents, I think some of the villa communities are caught in limbo because if you want a new property or if you want to trade up, there isn't a huge amount of stock there because people are holding on to what they have because if they're going to sell, they want to move somewhere that's maybe larger, albeit it'll be newer, but that stock isn't handed over yet. So you have so many villa communities that are under construction. People aren't making that jump as of yet because they don't have the options. I think in Q3 and Q4 of this year, you'll see more of them communities come on stream, and then you'll see transaction rise on the secondary market for that type of villa. And the same applies for townhouses. There's a lot of townhouses under construction at the moment, so I think people that want to move from an apartment to a townhouse will also wait for the right townhouse community to be handed over.
It's the crystal ball time. So, final question for you here. 12 months. Let's look at 2026. Your thoughts, your outlook, if you like, for the residential market in terms of, let's do the whole lot: prices, rentals, overall transaction momentum as well. I think that's important.
I think there will be growth or across the in values. I mean, in terms of the dynamic price index, I think it will be single-digit growth, probably closer to the lower end. But I think that will be again driven by off-plan sales, because obviously there's a pipeline of launches that are happening. There's huge land banks that are being developed. Yeah. So I think there's an appetite. If there is an appetite and the absorption rate is high for that, then the rates will high. Based on, again, it will be based on this off-plan market. So I think there will be single-digit growth over the next 12 months. It will be obviously less than last year. I think rents, you'll see rents come down because the more units that are handed over, the more supply there will be. I think it won't be across the market as a whole, but I think it will be different communities. Some will see rent growth, and some will still see some rent growth, but I think you'll see rents plateau in some, and you'll see some fall then, even within some communities, different buildings. I think a lot of it will stem from the off-plan market again.
I mean, I always kind of ask that question, hoping that you're going to say, the area you live in, Tim, the rent's going to dive in the next, and obviously that's not going to happen. But the characterisation earlier on, I suppose, was what I'm taking away today, that we're in kind of more of a balancing phase for this year. Is that reasonable?
I think that's fair to say. Yeah, I think that's fair to say. Yeah. I think we won't go from 12% to just flat. Yeah, I think it will be. I mean, it will come down. The rate of increase will come down, but I do see still there being some increase over the year.
Overall, pretty positive picture you're painting, Ronan, I think. Ronan Arthur is the director and head of residential valuation at Cavendish Maxwell, based here and in Dubai. Always good to talk to you. Thank you for coming.
Thank you, Tim.
Appreciate it. This is MIRA Business FM. It's the morning drive. Get in touch. Let us know what you think on social media. You can find us whatsapp.mira.fm, or you can write to info@mira.fm if you like emailing. A like and subscribe on social media is always appreciated. And remember, everything that we do, you can listen and or watch again on the website, YouTube, and also wherever you get your podcasts from. While I'm on the podcast subject, Luxury Breaks is another new podcast from us here at MIRA Business FM. It's Jacek Ziemek from X Motors, who is a man unafraid of controversy when it comes to cars. But that is now available wherever you get your podcasts. Just search MIRA Business FM and look for Luxury Breaks.